Hello there. Today I'm going to discuss with you this topic on business valuation, which is tipped to be the most important topic for your coming examinations. Now, this article appeared recently in the ACCA P4 technical articles, and my name is Ovian. Before I start, let me give full credit for the writer of this article, which is who is Mr. Sunil, for writing this beautiful, well-balanced article. Now, this article is going to be discussing on a few issues here. The most important issues that you're going to see in a while will be discussion on valuations of companies. That's called pre-acquisition valuation, as well as post-acquisition valuation. Now, there are many methods here you can go through here, but we are going to concentrate on this article on this method called free cash flows method. Now, this topic is very important topic, especially since December 2010, and let me show you there's a lot of questions that appeared since the December 2010. Now, the questions that you can see on the screen now is going to be a few, and I would consider that you do most of these questions, in fact all of these questions, before you go for these coming exams. Coming back here, now let me show you how to deal with this question within the article. Question name is Borgoni and Vinitra. Okay, now I'm going to give you some paragraph numbers here so that you don't get drifted when I'm reading this question. Now let's put this together. Paragraph number 1. This is going to be paragraph number 2, and this is going to be paragraph number 3, and this is going to be paragraph number 4, and this is going to be paragraph number 5. Okay, let's follow through. Paragraph number 6 and final paragraph number 7. Now, in your exam, I would suggest you to read the requirement first before reading the body of the question. Now, part A of the question, as at 1st of January 2014, prepare a schedule of Vinitra's forecast free cash flows of the firm. Now, you have to be careful. There will be two types of free cash flows that will be examinable in your ACCA P4. One will be the firm, the other will be equity. So you need to look for the question, what are they asking you? Now, free cash flows to the firm, you must understand it will be discounted at company WACC. If they ask you free cash flows to equity, then you got to discount that free cash flows to equity using cost of equity. And then here we have here as certain the fair value of Vinitra's equity on a per share basis. So it's going to be a per share basis. So if you happen to have a total value, you always have to divide that with the total number of Vinitra's shares issued as at 1st of January 2014. And that's going to give us equivalent 10 marks. Now, part B of the question, Borgoni intends to make an offer. Borgoni intends to make an offer for Vinitra based on a share for share swap. That means it's a share for share exchange. That means new shares will be issued in Borgoni to take over all the shares in Vinitra. Borgoni will exchange one of its shares for two of Vinitra shares. So that is the offer, that is the basis of exchange has already been established in this particular question. Now, the next thing we want to see here is, will Borgoni shareholder be happy and Vinitra shareholder be happy? But this question is concentrating in part C. What will you look for before you decide to accept the offer by Bergoni? That means Venitra shareholders' point of view. Anyway, coming back down here. Assuming Bergoni can maintain, now this is the assumption that I want you to highlight. Bergoni can maintain its earnings rating, it's another name for PE ratio, at 12.2. Calculate the percentage gain. Now it has to be in percentage gain in equity value that will be earned by both the groups of the shareholders. So this is going to give us 8 marks. Now this is going to be your post-acquisition valuation, and how will that make the equity value go up pre-acquisition? Now part C of the question is going to be, what factors should Venitra shareholders consider before deciding whether or not to accept or reject the offer for Bergoni? And it's going to be 7 marks. Now that will be explained to you in great detail. So it's basically to decide whether are Venitra shareholders happy. If they're not happy, what do they want? Now that will be giving us a total of 25 marks. Now back to the question on paragraph number 1. Bergoni is a very successful entity. The company has consistently followed a business strategy of aggressive acquisitions, looking to buy companies that it believes were poorly managed and hence undervalued. Bergoni can be described as a modern-day conglomerate, and its business interests stretch far wide. Now what we can stress here is that they're telling us that Bergoni is a very successful entity. It's a modern-day conglomerate. Now conglomerate is a company with many different industries. That means it's a fully diversified. It may be a fully diversified industry. If it is going to take over Venitra, and currently they are fully diversified, that means they will not experience any more risk reduction as far as the unsystematic risk is concerned. So if it's fully diversified, that means they might not have any change in business risk. Unless they are not fully diversified, then they may feel some risk reduction. Now, second paragraph. So the first paragraph is basically telling us that this company looks for companies that are poorly managed. It believes that Bergoni can manage them well and undervalue. Yeah, the belief is there. Okay, the second paragraph is that states that the board of directors has chosen the takeover targets with care. All right, the board of directors have chosen, always looking for companies with potential, but which are poorly managed. Again, we're getting the same sentence back here, and having a below par market value. Bergoni has maintained its PE, price earnings ratio, which we saw earlier in part B, which is price earnings at 12.2. It's given. Now probably if it's given, then probably Bergoni is a listed company, yeah, because it has its own PE. Now Bergoni's 2013 figures show a profit after tax of 886. Now this is going to be the earnings for Bergoni, and it has 375 million shares in issue. So pay attention to this one. This is for you to look at in part B of the question. Today's Bergoni's share is worth 12.2 into 886 in total, and you're going to divide that with 375 to get the price per share. Anyway, we'll come back to that later. Now Venitra PVT Private Limited Company is a well-established, yeah, owner-managed business. In financial term, it has a rather checkered history with its ups and downs corresponding directly with the state of global economy. And since 2008, profits have fallen each year, with 2013 value standing at. Now we know that the economy slumped since 2008, but now it's started to recover. But we're not sure whether it's still on the downtrend or is it on the is in the uptrend now. We're not sure about that, but anyway, we'll come back to that part later. Now in this same paragraph, we're going to talk about, this is a Venitra's revenue, Venitra's operating profit. Now please take your calculator and just take this figure divided with this figure. You should get a value in terms of operating margin on revenue. It's exactly at 32%. I'll tell you why in a while. Now interest is given here. Now you must remember, this is going to be a valuation of a company, which is free cash flow to the firm. Now if it is free cash flows to the firm, we do not show any interest, so we're going to blank this off. Is that clear? So we don't show any interest at all in free cash flows to the firm. So this is out. This is not important. When it's free cash flows to equity, yes, we do show that interest and your capital on loan repayment and loan issued and all that for free cash flows to equity. But to free cash flows to the firm, interest we do not show. The reason is simply by virtue that WACC will show everything. WACC will include that cost of interest indirectly in. Now profit before tax, it's given here at 343. Taxation is a 25%. Please highlight the taxation percentage here at 25%, and this is going to be your earnings of Venitra. And the number of shares issued at the moment of Venitra is 150 million. So if you take your calculators, 257 divided by 150, you're going to get around 171. Let's take that as 172. No worries. Now, paragraph number 5. However, the economists predicting an upturn. So we are told that it's going to be, the bottom has gone bottom. Yeah, it's no longer bottom, it's going to go upward trend now. And the Western economists, Venitra's management team, feel that the revenue will increase by 6%. Now they are telling us the revenue of 6%, and they are, if you notice that a few questions of this, in fact I should recall 3 here, they do not give you the growth rate. They will ask to tell, they will tell you to find the growth rate. If it's going to be a bigger mark question, if it's going to be a more than 25 marks probably, they'll ask you to find the growth rate. Now you can use the historical growth rate method. Yeah, historical growth rate method. There's 2. One is historical growth rate. The other one, which is also the Gordon growth rate method. Yeah, but so far I've seen there are 3 examples here in this one of these 3 questions. Is for you to find out. Yeah. Which question is talking about this historical growth? I think 1, 2, and 3. You can check it out. Okay. Now it's going to be 6%. 6% per annum up to and including 2017. So we're going to start with 2014 up to 2017. It's going to be 6%. The company operating profit margin is not expected to change for the foreseeable future. That means when you go up here slowly, that means it's going to be maintained at 32%. The company's operating profits are shown after deducting non-cash, including your TAD, including your tax allowable depreciation. Now you should know that free cash flows, we do not show non-cash expenses, but it is shown to get the right tax calculation. Then what we do here is normally we'll add them back, but anyway it's included in your operating profits. That means these profits are after your expenses, sorry, on TAD, yeah, non-cash expenses. Okay, now so your job will be need to add them back. Now this is expected to increase in line with sales, so which means the 6% come back to this particular operating profits is going to grow up by 6%. Sorry, this not operating profits, this is tax allowable depreciation is going to go up by 6% as well, for up to 2017. However, the company has recently spent 210 on the purchase of non-current assets, fixed assets, capital expenditure. Venitra's management believes this value will have to increase by 10%. So they're giving you 2 growth rate. That's going to be a little bit tricky. I mean, not tricky, time consuming if you're going to have 2 growth rate. Until 2017 to enable the company to remain competitive. Venitra has estimated its overall cost of capital to be approximately 12%. Now make sure this is your WACC. Make sure this is your weighted average cost of capital. If they have given you cost of equity, then you have to find cost of capital weighted average. But in this case, they've given us cost of capital, so it's going to be 12%. So we're going to take that 12%, is fine. In a bigger question, they may ask us to find the cost of capital before asking you to find the free cash flows to the firm. So, but it assumes that it will be maintained. So basically what they're trying to say here is that the financial risk is going to be maintained at 40-60 debt equity ratio. So this is like kind of type 1 of business valuation, where your financing risk is the same. Anyway, don't worry about the type 1, type 2 and type 3 here. Now some of Venitra's major shareholders are not so confident about the future. They're not worried, they are not so confident about the future. They're worried and would like to sell the business as going concern. So they want to let go. They're not very happy with the future. So they want to sell when the business is still ongoing. The minimum price they would consider to be a fair value of these shares, whatever share that we're going to do, valuation of a share. In this case, we're going to use free cash flows to the firm, plus 8, and they're asking for a premium of only 10%. Now, you and I should know that the market out there is asking for around 20% and more in today's world. Yeah, in today's world, the premium is being around 20 to 30%. It could go up to 50, but generally it's around 20 to 30% if you've read business news. Okay, Venitra's CFO believes the best way to find the fair value of the shares is to use a discounted forecasted free cash flows to the firm, assuming that beyond 2017, this growth rate will increase by 3% indefinitely. So there's 2 growth rate. Again, I want to share with you that there are a lot of questions in here. There are always, the examiner likes to test us 2 growth rates. So this article is based on that as well. Okay, so I think we are ready to start our answer as for part A of the question. Okay, now so it's going to be on a free cash flows. Just make sure that you know what you're going to do in a while. It's going to be free cash flows to the firm at WACC and it's going to be the per share basis. So we're going to write that free cash flows, yeah, forecasted of free cash flows to the firm, and the value of equity for Venitra. Now what I would like to do here is I'm going to draw the year for you. This is going to be year 2014, 2015, 2016, 2017, 2018 to infinity. We'll do it separately. Is that okay? We'll do the 2018 to infinity in perpetuity separately. So this is going to be time 1, 2, 3, 4, 5 to infinity. Okay? Now, what are we going to do is all this will be in millions of dollars. It's given in millions of dollars. And we are told that free cash flows to the firm is going to grow at a rate of, from this paragraph here, number 6, yeah, number 6 and number 5. So we got to look at, pay attention to number 6 and number 5. Let me clean my whiteboard here. It's going to be growing at a rate of 6%. So what is growing here is this revenue is going to grow. This is at 2013. Now we're going to go for a forecast of 2014. So what are you going to do is you're going to multiply this with 1.06 and keep multiplying that with 1.06. So we're going to have this thing here called sales or revenue, which I'm going to show you a little working for the first year. For 2014, I'm going to show you working onwards is going to be 1,500 multiplied by 1.06%. So if you press your buttons, you're going to get here, the value here is going to be 1590. You keep pressing and multiply again with 1.06. Okay, I'm using many colors here, but in exam please make sure you use black ink only. All right, so you've got to multiply by 1.06. 1590 multiplied by 1.06 is going to give you an answer of 1685. Keep multiplying by 1.06. If you press equals to, I believe you can get your answer now. 1787. Press equals to, you're going to get 1894. Now that's the sales figure or revenue figure. Now from this revenue figure we could estimate our operating profit, and we are told that the operating profit is 32% of the revenue. So what you can do here is you just multiply by 32% of that particular 1590 times 32%. It's going to give you an answer of 508.8. Keep that figure. 509 is what we're going to write here, rounded to the nearest million. Now the second way of doing it is whatever you have here, you can keep multiplying by 32%. But if you're lack of time, you just multiply this with 1.06. You're going to get the answer 1.06. You're going to get the same answer, 539. Keep multiplying, equals to, just press equals to, you get your answer, done. 572, press equals to, you're going to get 606. There you go. Now once you have got your operating profit, what are you going to do here? There's no interest. Remember, there's no interest. You straight away you're going to have to put in your tax. You can't put in your tax at 25%. Now tax is at 25%. The only place they've given you taxes in this particular financial statement itself is going to be 25%. Now 25% on this is going to be 509.25. It's going to give you 127. Shortcut will be keep multiplying by 1.06. Multiplied by 1.06 is going to give you a figure of 135 in brackets. You're going to have 143 in brackets. Keep multiplying equals to, you're going to get 152 in brackets. This is exactly 25% of 606. Yeah, it's going to be 152. Now you must remember, free cash flows to the firm or free cash flows to equity, for doesn't matter, you have to always add back your TAD, or in this case we call it non-cash expenses. Now what I would like to tell you here is I've seen so many questions in your ACCA P4, namely a few questions from here, that they will tell you this point. Just point this note. Yeah, you have operating profits. Let's say, for example, you have operating. Let's give an example here. Now you have an operating profit. Then you have also minus off with TAD here. Let's say TAD was 125. Now you're going to get operating profits. Then you're going to calculate your tax on the operating profits. Then what you do is you add back your TAD, which is going to be non-cash item. You need this actually to calculate your tax. Otherwise you have to show there are two ways, which is a waste of time. Now you're going to put the TAD back here. Here you minus, here you're going to add back here. That is what we are exactly doing here today. Now your operating profit is after, is mentioned in this particular part of paragraph number 6. It's after deducting non-cash expenses, which is 125 into this term. 125 into this term. Okay, so the 125 has been, let me just stick with 125. Yeah, this is in year 2013. Okay, just in 2013. So what the examiner will tell you, there will be a capital expenditure, and there are numerous times they tell us that capital expenditure and the TAD happens to be the same. So when they say that this two is the same, you can just ignore this one, and they may not give you this as well, because it's not important anymore, because you're going to start with operating profit. If you're going to start with operating profit, you just put in your tax. This two, you don't even have to know how much the figure is, because they're going to set and cancel off each other. Anyway, that is past exam questions, but this question is giving us the TAD, which has been included in the 2013 inside here 125. So what are we going to do is we're going to calculate the TAD 125 multiplied by 1 point. Well, the question says that TAD is in line with sales. It's not in line with capital expenditure, it's in line with sales. Okay, so we'll take 106. So this figure is going to be 125. Let me check. 125 times 1.06. It's going to give you a figure of 133. We're going to add back. So keep multiplying by 1.06. You're going to get here 140. You press equals to straight away. You're going to get 149. Press equals to, you're going to get here 158. Now, less this thing called capital expenditure. Now let me tell you something. In exam technique, we know that P4 is a very stressful paper in exam, and you may not be able to finish all the questions if you do it very neatly and complete, because 3 hours sometimes students find it difficult. Yeah, we tutor find it okay, but sometimes students, lack of practice, they've wasted probably on time on other questions. Probably if this is the last question you're going to do and you have only 10 minutes, if you have only 10 minutes, if you got a time, please complete this. But if you don't have the time, what I would suggest you to do is you do a sub margin here, because all the growth rates are the same. So what are you going to do? You're going to get this figure down here and ignore this figure and just put 1.06, 1.06, 1.06 and come back and fill this up if you have the time at the end. If you don't have the time, just leave it as it is, and I'm sure the marking team will be very generous to give you a pass mark for this particular part. All right, now we have the time. Yeah, we have lots of time, so we're going to fill up everything in slow and steady. Now we got capital expenditure over here. Now this capital expenditure is going to be, there's no mention about capital expenditure here. They're telling us that however they've recently spent capital expenditure. Recently means, I believe it's going to be on 2013 report. 2013 recently spent 210 million on the purchase of a non-current assets. So it's going to be 210 multiplied by, they're going to grow by 1.10. Yeah, they're going to grow by 1.10, which is 10%. Now if it's the same, then you can just put at the end and then only grow by 6%. But in this case, there's two growth rates within the 4-year period. All right, for capital expenditure is different, for the others are different. So this is going to be 231 in brackets. Brackets denotes outflow of funds, and then you keep multiplying by 1.1. You're going to get 254. And press equals 2, you're going to get 280. Press equals 2, you're going to get 307. Now there you go, and we are ready to find the valuation for the first 4 years only. Yeah, first 4 years. Free cash flow to the firm. Yeah, free cash flows to the firm. Start with operating profit 509, take away 127 plus 133, take away 231. It's going to give you 284. Okay, pause the video and fill up the rest. Okay, I believe you have found the answers. You got 290 and you're right. If you got 298, you're correct, and its last figure you should have got is 305. And you must remember that this question, usually if you've done most of these questions, sometimes they'll give you a working capital. Yeah, this question we're not tested on working capital, so probably that point we can write it later for our purposes. So there usually will be a working capital changes happening here. So in this case, we probably need to assume there's no change in the working capital based on the sales increase. So this is going to be free cash flows to the firm. We're ready. We're going to have a discounting factor. Stress to the examiner that this is going to be the WACC, and it's going to be at 12% given. So you're going to get the discount factors. You can use the table or you can use the calculators. I like to use the calculators. So equals to, this is going to be year 1. Yeah, this is going to be in year 1. So it's going to be the first year. So the discount factor at 12% is, we'll take 3 decimals because the table gives us 3 decimals. If you want to use, sometimes the examiner uses the whole value. You can also use 1.12 to the power of 1 or 1.12 to the power of -1. Fine, any answer is acceptable, I believe. So this is going to be 0.893 equals to 0.797 equals to 0.73 decimals will be 712 equals to 636. Okay, now then what are you going to do is I'm going to stop here because we're going to get this figure out, multiply, round it up to the nearest million, present value of free cash flows to the firm. You can call it company if you want to. 284 multiplied by 893 rounded to 254. This multiplied by this should give you 231. 298 multiplied by 712 should give you 212, and this is going to give you 194. Now you have got the first 4 years value ready, but what I'm going to show you is year 5 to infinity on a different sheet. Yeah, let's come here. Now this is going to be the value of, careful the word here, value of entity. Okay, this is going to be the value of entity or the value of the firm. You okay with that? Now what are you going to have here is year 1 to year 4. We have got that total value. What I want you to do here is get the total of all these 4 values. It's going to be 254 plus 231 plus 212 plus 194. It's going to give you 891. So this is going to give you 891 in dollar million. I'm going to put into my far right, and I'm going to show you now valuation for year 5 to perpetuity or infinity. Now there's a little formula that you should know by today, but we'll explain to you why we need to use that formula. Now this is free cash flows year 5 to infinity. Now let me stress with you that the dividend valuation, let's go back to our basics. We have a dividend valuation model where we say year 1 to infinity, the value equals to D1 over KE, cost of equity, minus G. I mean, this is going to be simply the price, and it's given in your formula sheet here. If you look at it here, this is D1. D1 is DO1 plus G. Coming back here, oops, where's my page? Okay, it's here. Oh, not this one. Where is it? Okay, not this one. Okay, this one. Okay, we have D1 KE minus G. Now this D1 is actually DO1 plus G. Yeah, DO1 plus G. So if you have D1 value, DO gives you the value of your price at PO. So if you are finding DO, if you're using PO in your given DO, that will be the PO price. But let's say, for example, if I'm going to find year 5 to infinity, then I'm going to use D5 over KE minus G. D5 is actually D4 multiplied by 1 plus G. So the value that you're going to get is actually going to be, if you look at it here, DO is PO, D4 is actually going to be a P4 value. It's going to be a P4 value. So if it's a P4 value, then let me go back here a bit. This is actually a P4 value. If this is, sorry, not this one, this is a P4 cash flows. Yeah, this is a P4 cash flow. So what do you do to get the present value? You need to multiply by this. So if it's going to be P4 value, then I need to multiply with a discount factor factor for year 4. Yeah, so what I'm going to do is I'm going to use this. I'm going to multiply with a discount factor for year 4. This is financial mathematics, so let me write this here. This is going to be equals to free cash flow to the firm year 5 into KWAC minus G. Same formula as per dividend valuation perpetuity model. It's just that the dividend we change to free cash flow. Back to here. But remember, this is going to be a value. This is going to be a value at year 4. So I have to multiply with my year 4 discounting factor, which is going to be 636. So coming back down here, I'm going to multiply with 0.636. Again, FCF firm 5 is actually FCF firm 4 1 plus G into KWAC minus G multiplied by 0636, which is equals to free cash flows year 4. Now free cash flows year 4 is this one. Now this is going to grow by 1 point according to this question on this paragraph here. Number 7, yeah, paragraph number 7, we are told in this part here that beyond 2017 is going to grow by 3%. So we're going to have here 3% as your growth rate. So this is going to be with 305. We got that just now here. 305, we got that here, 305. Multiplied by 1 plus 0.03 divided by your WACC, which is 12%, minus your growth rate beyond that. Again, I want to stress this value is a year 4 value, so that is why we need to multiply by 636. And if you press your buttons, you're going to get here 2,220 millions of dollars. Okay, so now there's another way of doing this. If you want to, there's another way, there's a faster way of doing this. To some people are confused, you know, until at P4 level they're confused with this, all these things. So let's make it simple. Let's use the present value. That means you're straight to the present value. No need to worry, because present value is what you need. We don't care about this figure. We are going to grow this figure by 3%. So it's going to be 194. It's already present value, so there's no question about whether it's a present value or not. So this is going to be a present value 197. Instead of 305, you put there 194, correct? 194 multiplied by 1.03 divided by 0.12003. Well, you should get the same answer straight away. You don't have to worry about multiplying by 636 and all that. Just take this is present value, this is present value, so this is going to be straight away present value, taking into account the growth rate of at 3%. Fine. Next, what are we going to have here? We're going to have it's 891 plus this 2220. If you're going to get the total down here, it should be a value of 3,111 millions of dollars. So you're going to get a 300 and I'm not sure, it's 3,111 million dollars. Now this is technically speaking the value of the firm. Remember, this is a free cash flows to the firm. this is going to be the value of the firm. Modigliani and Miller would have called it a value of a geared company. Yeah, it's a combination. It's a combination of value of equity plus value of debt inside here. So what are you going to do now? We are interested from this requirement. We are interested. I want you to highlight this word. Too many highlights here. Let me clean my whiteboard. It's going to be this. I want you to highlight this equity. It's not the entity per share. This is going to be equity. So pay attention to the exam questions carefully. Is it whether it's an entity or whether it's equity? So in this case, it's equity. Equity value. Well, we are told in this paragraph here that number 6, yeah, paragraph number 6, look at this point here. Yeah, look at this. This is going to be at a 40% debt. Yeah, 40% debt to equity. So it's going to be 40% debt. Equity is 60%. So this is going to be 60% of that 3111 multiplied by 60% is going to give you an answer of 18. I'm going to round it up. $1867 million. That's going to be the value of equity for Venitra, and they want us to calculate per share. Okay, per share. So it's going to be divided by number of shares. So what is the number of shares in Venitra? The number of shares in Venitra is given in that paragraph number 4. That's here. Number of shares in Venitra is 150 million shares. So we're going to divide it with 150 million shares. I'm going to use 1867. Okay, I'm going to use 1867 divided by 150. I'm going to get a 3111 multiplied by 60% is 1866.6. I wrote here 1867. I'm going to use 1866.6 divided by 150. That's what usually the examiner does. Yeah, I just want to highlight to you this one. It's divided by, you're going to get here a price for Venitra per share pre-acquisition using free cash flows methodology to firm. It's 12.44. Now you can stop here and go to the next part, but I like to give you a full answer here. What I would do is, if I got the time, I'm going to write something. I'm going to make some assumptions and notes here. Okay, so this is going to be your marks. So I'm going to put down some assumptions and notes. Remember, P4 is not just about calculation, it's also about writing something that you have calculated from. So the first point here I would like to say here is capital structure. Capital structure. Maintain in the foreseeable future. Foreseeable future. Yeah. At 40-60 debt to equity ratios. That means we're not going to change our capital structure, because if you're going to change the capital structure, then the valuation may be different, because by virtue your WACC is going to change. WACC. So we're going to make some assumptions somewhere. We're going to assume that the business risk remains the same. Yeah, we're going to assume that the business risk remains the same. We're going to say if my financial risk is the same, my business risk is the same in note number 1 and note number 2 assumption. I'm going to say my WACC is going to be the same. It's the same till infinity. Number 4, I'm going to say, well, my growth rates do happen as predicted. Yeah, we're going to say the growth rates do happen as predicted. That is the 6% and 10% and also 3%, which is beyond 2017. And one more point I'd like to highlight to you here is working capital does not grow in line with any figure, with sales. Let's put it as sales. Working capital do not grow in line with sales. That means we don't have any working capital increase, therefore there's no cash flows for working capital. Now that will be my answer for part A of the question. Now part B of the question. Yeah, part B of the question. It's going to be the interesting part. Part B is going to be the post-acquisition valuation. Now, Borghini or Borgoni, however you want to pronounce it, is fine, intends to make an offer to Venitra. So Borghini is coming in to make an offer to Venitra. Now they're giving us only one option here, which is a consideration of share for share swap. Now there are many other considerations, which is can be in cash consideration, cash and share, could be debt and share, and a mixture. Yeah, Borgoni will exchange one of its shares for two of its Venitra shares, assuming Borgoni can maintain its earnings at 12.2 percentage gain of equity value. Equity value, not the entity equity value, will be earned by both the groups. So we must emphasize on both the groups of the shareholders for 8 marks. Now let me give you a very detailed answer. Maybe we can get more marks for that. Yeah, so my time will be running out of that 8 marks prescription. Okay, now part B, we're going to say Borgoni, P-O-R, Borgoni. Let's put it as B as Borgoni is taking over Venitra. We're going to assume they're going to take over all the shares. Venitra, all the shares. Now it's going to be a share for share exchange. Only. Yeah, that is only a share for share exchange only. The next thing I'll say is it's going to be 1 Borghini shares for 2 of Venitra shares. Next we are going to say we are told the PE of Borgoni is 12.2. We are told the PE of Borgoni is 12.2. We can find PE of Venitra. PE of Venitra will be PE of Venitra is going to be based on the PE ratios, P over earnings per share. Now the price here, the price that we just got just now in part A of the question, Venitra's price is 12.44. Yeah, you can box these answers if you want to. Yeah, it's easy for the markers to mark, especially if they're marking during World Cup time. Yeah, so this is going to be 12.44. Yep, 12.44 divided by earnings per share of Venitra. It's already given to us in the body of the article itself, 1.72. So we're going to take this one as 1.72, and you're going to get here 12.44 divided by 1.72. It's going to give you a PE of 7.23. So that's the PE of Venitra. So we have PE of Bocconi, which is given 12.2. This is 7.23. Now, we are also told that the post-acquisition PE, the post-acquisition PE of Bocconi, which is 12.2, to be maintained. Now, if you are going to use a PE, now two companies coming together, usually the PE will not be maintained at 12.2 in this case, but in this case we are told that the PE will be maintained in the requirement. Now we're going to tell the examiner, or we're going to tell Mr. Sunil, that this is an example of bootstrapping. This is an example of bootstrapping, i.e., trying to convince the market. Yeah, we're trying to convince the market. Bootstrapping is an example where you use a higher PE and trying to convince the market, yeah, to use a higher PE for valuation. So here I've explained to you what do you mean by bootstrapping. Bootstrapping is trying to convince the market, to persuade the market to use the valuation at 12.2 PE. Now, and also in this question, yeah, there is no direct information. Yeah, there's no direct information about synergy. Yeah, there's no direct information, anything about synergy. So anyway, we are told that this is a successful, usually is a modern conglomerate. Modern conglomerate is basically a company that buys many different industries. So this is not like a horizontal merger or a vertical upward merger or a vertical downward merger. Probably there won't be any synergy if you merge with a company that is unrelated to you. The only thing is you can have here is a risk reduction. Yeah. Now, anyway, there's no direct information. The only information given is that Bocconi can maintain the PE of 12.2 with its conglomerate experience. Okay, now assuming the market falls for this, assuming the market falls for this, the price can be computed as follows. When I say the price, I'm talking about the post-acquisition price. The post-acquisition price, which let me just make sure you're okay with this, the post-acquisition price will be equals to the earnings per share, which is of the combined company, multiplied by the PE ratio. Yeah, so we need to know the PE. We have the PE here. We just have to find out the price, earnings per share, and all that. Now, before we go into that calculation, let me just establish the price of Bergoni, because we don't have the share price of Bergoni directly. Let me just establish that one first. Now, first we're going to establishing the current market price of Bergoni and Venitra. We know Venitra's one, but we'll just write it down. Yeah. Let's talk about price for Bergoni. Bergoni's share price. Let's talk about Bergoni's share price is simply equals to earnings per share of Bergoni multiplied by a PE of Bergoni. Now we are told that Bergoni's PE is 12.2. The earnings per share of Bergoni will be as per your paragraph number 3. If you look at this paragraph number 3, you have earnings data for 2013, 886 divided by 375 is going to give you the earnings per share of Bergoni. So you come back here, you're going to write here 886 divided by 375. So you're going to get here 886 divided by 375 multiply straight. We're going to get an answer of 28.82 per share. So this is the share price of Bergoni today, pre-acquisition price for Bergoni at the moment. Yeah, price of Venitra. Venitra's share price is from your part A. I recall this at 12.44. Is that okay? 12.44. You have it here. 12.44. So you're going to put here 12.44. Now, so you have that one. So now we're going to have to find out what's your post-acquisition price. Still based on a PE basis now. Yeah, still based on PE basis. Examiner could also test you on a valuation of post-acquisition using a free cash flows again. Yeah, so if they ask you free cash flows, then you have to use the combined free cash flows, and there are a few questions here that you can use to practice. Yeah, one of them is pursuit. Now, post-acquisition price. Post-acquisition price. How do you find post-acquisition price? Now, I'm going to use my earnings per share. This is the formula that I'm going to use. I'm going to stick to this method. Yeah, we're going to stick to this method for post-acquisition price, because the question specifically says maintaining PE at 12.2. So we're going to use this. So we're going to find earnings per share. So before you find earnings per share of the two combined companies, so we have to find the earnings first. Now, earnings in dollar million is equals to Bergoni 886. Bergoni 886. Venitra will be 257. Venitra's is 257 based on historical earnings method. So we're going to use the current 2013 earnings. So we're going to plus this 2 as my earnings, which is going to be 886 plus 257. It's going to give me 1143. Yeah, it's going to give me 1143. Now, next I got earnings. I want to find my earnings per share. If you want to find earnings per share, you must find the new number of shares. The number of shares is going to be, you got brought forward, right? You got a brought forward number of shares in Pagani, which is, let's go up here, brought forward shares, you have 375. Let me tell you, this is going to be a new share issue to take over Vanitra's shares. So this is going to be 375 million brought forward shares. Now you're going to add on new issue or new share issued, which is going to be, the basis is mentioned in that requirement here, that you are going to issue one of its shares for 2 of Vanitra's shares. So 1 for 2. So it's going to be, how many shares does Vanitra have? Vanitra have 150 million. So it's going to be 1 for 2. That means Pagani give 1 for 2. So it's going to be 150 million shares. 1 into 2. You're going to add on another 75. So the Pagani will issue 75 of Pagani shares for 150 Vanitra shares. So this is going to be plus 75. So this is going to give you 450 number of shares. So if you just pick up your pen and if you're going to put a divide here, then you're going to see the earnings per share. You're going to get 1143 divided by answer. It's going to give you 2.54. So this is going to be my earnings per share, new post combination. Is that clear? This is post acquisition. Now post acquisition, it's 2.54 per share, multiplying with my PE at maintained PE. Actually what I'm doing here is I'm doing this. I'm just doing this. I just got this. Now I'm just putting it inside here. Okay, we're going to get 12.2 multiply. This is going to be the price of Pagani after the acquisition. So 2.54 multiplied by 12.2. It's going to give you 30.99. You can call it 31 if you want to. Yeah, we can just put 31 as an answer. Should be acceptable. So it's 30.99. So obviously it looks cheaper. Yeah, if you want to convince them, just put 31. Yeah, looks a bit high. Now, so we have here 30.99%. Now, what are we going to still answer here is, if not the end of the question yet, because they say what is the percentage gain in equity for both the shareholders. Okay, we're going to have a new picture. We're going to call percentage of shareholders gain. Now percentage of shareholder gain is going to be like this: Pagani shareholder post acquisition. So if you hold 1 Pagani shares, shareholder pre-acquisition, before that acquisition, after that acquisition, well, you still have the same number of shares. Remember, you still have the same number of shares. If you have 1 last time, which is worth 28.82, which is from this particular calculation that we got here just now, establishing the current price of the Pagani is 28.82. That was what you had last time. Today your price is $31, right? I think it's $30.99. In other words, you have gained a capital increase up 2.17. This is your increase in the price per share of Pagani. Remember, Pagani shareholders will not feel any change in their share position They had one old Bergoni shares. Today they'll still have that one same Bergoni shares, which is now worth 30.99. So in percentage gain, we're going to put 217. Since we already have this, we don't have to show the minus and all that. We just might divide it by original price 28.82, multiply by 100, so you're going to get 2.17 divided by 28.82 multiplied by 100. It's going to give you a percentage of 7.53% increase. So it's going to be 7.53% increase. That's for Bergoni. Now, should they be happy? Well, they should be happy because the price went up post acquisition. Other reason, I mean, the question didn't ask us, will Bergoni shareholders accept? Now, points that you need to consider is if there is synergy, was it shared fairly? Yeah, that is also a point where Bergoni want to check. And are they letting go so many percent? Now, if you look at it here, how many percent is this? You take this, divided by this. So you're going to 375 divided by 450. They're going to have a control of 83%. I think they should be happy because the control is not let go. They still have a 75% and above to block any special. They can avoid the special resolutions blocking them. I mean, 75% and above is a good percentage to control a company, so they should be happy here. In terms of premium, not premium, in terms of increase in price, is 7.53, and then there are other calculations there are a lot of questions to see whether was the synergy fairly shared and all this stuff. Okay, but anyway, this question we are going to continue. We're going to continue to Venitra's shareholders now. Venitra's shareholders. Let me change my color. Now, Venitra shareholders is going to be, they're given 1 Bergoni shares for 2 of Venitra's shares. Okay. Now, 1 Bergoni shares post acquisition is 30.99, and this was swapped with exchanged with exchanged from 2 Venitra shares. 2 Venitra shares is worth 2 multiplied by, in your part A of the question, you have done at 1244. So you're going to get 2 times 1244 is going to give you 24.88. In other words, they use 24.88. They let go 24.88. They let go 2 of their shares to take over 1 of Venitra's shares. So in other words, they have got a gain of $6.11. Now remember, this $6.11 is a gain for giving up 2 Venitra's shares. It's a gain for giving up 2 Venitra's shares at 6.11. Therefore, now we're going to find out. Now this is 2 shares. You got 6.11. Therefore, the gain per share for Venitra shareholders is you just divide it by 2. So you take 6.11 divide by 2. It's going to give you 3.06. So the gain per share, that means the price went up per share. There are many ways of doing it. Okay, I've used Bergoni compared with Bergoni. Bergoni with what you're going to get for 1 Bergoni shares. You get 2 Venitra shares. If you get 2 Venitra shares, this is your worth of your share today, and you're going to swap with 1 Bergoni shares. So this is going to be in percentage gain. Percentage gain again, 3.06 divided by, there was the increase from 1244. Yeah, increase from $1244 multiplied by 100. It's going to give you a good premium. Premium on acquisition is 24.60%. This is going to be an increase, yeah, of 24.60%. So this is how I would answer part B of the question. Now, the next one is going to be part C of the question. Now, what factors should the Venitra shareholders consider before deciding whether to accept or reject the offer made by Bergoni, which is 7 marks? Will they accept? Will they be happy? Now let me give you in a point forms. But at every point forms, make sure you write the full sentence. Yeah, point forms, paragraph, short paragraph are allowed, provided it's in full sentence. Okay, now part C of the question, let me put it more interesting question here for you. Will shareholder of Venitra be happy? Yeah, will shareholders of Venitra be happy? Now we're given 7 marks here. So how many points you want to write? You can let go all the points that you have and throw away your time, or just choose 7 points to write. Okay, I'm going to write like 7 points here. The first point I would say is the acquisition premium big enough? All right, is the acquisition premium big enough? That's the first question. We're going to elaborate by saying Venitra got 24.60% based on this deal. Venitra got 24.6% based on this deal. And we are told somewhere in the question that in the last paragraph here, last paragraph here, yeah, we are told somewhere in this question that they are happy if they get a premium of 10% premium. So they got more than what they want actually. Now minimum Venitra wants is only 10%. Then we're going to say therefore should be happy. Therefore Venitra should be happy. But let me tell you something, the premium in the market today, it's around 20 to 30%. Yeah, if you're going to ask for 10, something is wrong in the market, in your market. Okay, so probably market is downturn, so they just want to cut loss and get out of here. Okay, that was the first point. They should be happy. The premium is big enough. Second point I would like to say is the method of consideration. Okay, method of consideration. Now, what was the method of consideration here? Share for share exchange. Yeah, it was only a share for share exchange. Share for share exchange is the only method given in the question. Yeah, share for share exchange. Will they be happy? Will they be happy? End of the day, we're going to come back to answer the main question here. Will they be happy? Well, it depends. Yeah, what are the advantages? Let's talk about some advantages. Advantages of share for share swap. Advantages of share for share exchange. Now, Well, you're going to have this continued interest. You explain in full sentence, okay? Continued interest. Yeah, that means it's ongoing business. You are still active in the business. If it's for cash exchange, you take the money and you run. So basically, you're not interested in the well-being of this company anymore, and you are not having any business in the future unless you're going to invest this money somewhere else. But if you're accepting share for share exchange, you are still relevant in a business. Continued interest on an ongoing business, as well as tax planning. Now, you should remember that in most countries, except for certain countries like Malaysia, is different. But if you're selling the share and receiving share, it's not taxable. Yeah, it's not taxable. The capital gain will be rolled over. Yeah, there'll be a rollover to the other particular shares. Yeah, but if it's for cash, then the income tax will come and tax you under capital gain tax. All right. Remember, this is a P4, yeah, advanced financial management. It's not a Malaysian variant or a Singapore variant or whatever. So you got to be thinking global. Yeah. Generally speaking, you're going to have some tax savings if it's going to be for share exchange. So you're going to say therefore you should be happy. Well, it's advantage. Definitely it should be happy. All right, but you also must talk about maybe some disadvantages. Now, these answers are comprehensive, yeah. So you may want to make it shorter and write it for your exam purpose. But since this is like a revision, so I'm giving you the full answers that I want to give. Now, the advantages of it's going to be the value not certain. Yeah. Remember, if it's for share exchange, the value will not be certain because the offer might be made today, but the actual transaction or the share will exchange 3 months later. So during that period, what if the share price of Bergoni goes down? So the offer of 1 Bergoni shares for 2 Venitra shares would be different, and the percentage gain or the premium may not be as relevant as 24 point something just now. So you must remember, cash is very certain. Cash is an unambiguous offer. Share for share exchange is unless it's given today, offered today, given today, everything is done today. You take the shares and you're going to sell in the market, and if you can get today's price, then fine. But you are going to get the offer today, and probably they're going to close every transaction on maybe 3 to 4 months from today. At that point of time, we don't know what's going to happen to Bergoni shares. Yeah, so this is what I have to say. The value is not certain. So conclusion probably for this particular part here is Bergoni, if you want to make it successful, because they're not happy, Venitra may not be happy. So if Bergoni may want to have a choice given to Venitra shareholders, i.e. cash offer or share for share offer. So give them a choice. Obviously, cash offer is not going to be that good compared to share for share offer based on today's term. But the only certainty is that cash will remain the same. The time transaction is going to take place a few months later. So you must give them a choice of mixture of offer. Let them choose. Probably not all will go for cash. Some will go for cash, some will go for shares. Probably you can modify it by saying, because some of them may want some income. Maybe you give them debt plus cash, a bit of debt. That will give them interest yeah, interest income, that kind of thing. Okay, now that will be too much of this second point here I've mentioned. Let me just go to point number 3. Now point number 3 is, I'm going to say here, the value of Venitra shares is based on forecasted free cash flows of the firm, and it's based on forecast. Yeah, it's based on forecast. The value of the shares based on free cash flow of the firm, and based free cash flow of the firm, and it's based on forecast of future cash flows, and with lots of assumption. Yeah, and with lots of assumption, Venitra may want to do a risk analysis to reduce the error, yeah, to reduce the error on its actual share price. Probably would suggest you to do some sensitivity analysis and all that. Yeah, fourth point. Not all shareholders of Venitra may want to sell. Not all Venitra shareholders may want to sell. Remember, Borghini needs only 50% and more to control. All right, there may be supermajority clause, yeah, supermajority clause in the article of association. Now this is a pretty big defense. So if they have incorporated a supermajority clause that the sale can only go through upon approval of certain percentage of a shareholder, then it's going to be difficult for Borghini to come in, yeah, to block the offer. So Venitra shareholders may want to know, is there such clause and all that. Okay, number 5. Venitra may not want to sell. Yeah, now probably, yeah, my guess is Venitra may not want to sell. Now perhaps the worst in economy, probably put it this way, the worst in economy is over. Yeah, perhaps the worst in economy is over, or perhaps Venitra shareholders want to wait when the economy recovers. Yeah, when the economy recovers fully before making a sale. Now the economy is already recovering. Probably they say, why are we selling at the beginning stage of recovery? Maybe we should wait for a few more years, 1-2 more years before we decide to sell. Okay, that was point number 5. Okay, point number 6. Now point number 6, let me explain to you in detail. Yeah, I'll give you a very detailed explanation for point number 6. It may take some time. It's okay to invest the time today so that in your exam you'll be laughing when you look at this type of question. Now, what if market does not believe in PE of 12.2. What if the market does not believe in the PE of 12.2? Which means the post-acquisition value may not be the one that we got just now, 30.99. So let's say the market didn't believe it's going to be 12.2. So the new PE now will be calculated. Yeah. So the market will say, this is what the market does. The market does says is the new PE may be taken. Maybe, I'm saying this, may be taken as a weighted average the new PE may be taken as a weighted average of the two companies' PE. Alright, the new PE may be taken as a weighted average of the two companies' PE. Now the weightage that you can use here is two. I mean, one of it is going to be your earnings as a weightage, your earnings and my earnings put together. Whose earning is more will have more of their PE represented in the end PE. Or you can use the total market values of the two companies. Whoever is bigger, they will have their PE represented more at the end PE. So let's take earnings as a basis here. So if you're going to take earnings as a basis, now we know that the earnings of Venitra is 257 and Bergoni is 886. So we're going to find the weighted average PE. Your weighted average PE is 12.2 multiplied by 886 divided by 886 plus 257. This is going to be the weighted average concept. Yeah, weighted average. Your one with your earnings plus their one. Now their earnings PE ratio we have calculated. Let me just go and show you where is it. Now the PE ratios they have calculated. It's here. Okay, it's here. Now where is it? Okay, where is it? Okay. Oh yeah, it's 7.23. Venitra's PE is 7.23. Okay, Venitra's PE is 7.23. Go down, go down, go down, go down, go down. Okay, it's here. Okay, 7.23. We're going to have 7.23 multiplied by the total of their earnings, which is 257 over 886 plus 257, and you're going to get a PE of 11.08. So you're going to get a PE of 11.08. It's not 2.23. So the new price of Bergoni post-acquisition is equals to the new PE multiplied by earnings per share of the post-acquisition, which is equals to 11.08 multiplied by the earnings per share of the post-acquisition is going to be found at this particular data. We got the where is it? It's here. Earnings per share. It's here. New earnings per share. Sorry, I'm highlighting so many things here. Yeah, make sure in exam don't simply highlight everything. So it's going to be 2.54. So we're going to have here 2.54 2.54 is equals to 11.08 multiplied by 2.54 is going to give you 28.14. Now instead of 30.99, it's going to be 28.14. Now what's the acquisition premium now? What's the acquisition premium? So the PE will not be there. So one of Bergoni worth 28.14. For two of Venitra shares, which is 2 times 1244, part A of the question. Yeah, remember 1244, part A of the question. So this is going to be 24.88. So you're going to get 28.14, 24.88, giving you an answer of, how much is that? 28.14 take away 24.88 is going to give you 3.26. It means they've gained, okay, minus 28 point, let me just make sure it's right. The 3.26 is gain for 2 Venitra shares. So what is the gain per share? Divide by 2, sorry, 1.63. Yeah, it's going to be 1.63 per share. Now, so what can I say here is that the percentage gain per share this time round is 1.63 into, what's your share price? Yeah, 12.44. I hope you still remember this one. 12.44 multiplied by 100. 1.63 divided by 12.44. It's going to give you around 13.1%. Still more than minimum of 10%, but is less than what the current market premium offers, which is around 20 to 30%. 20 to 30%. So you shouldn't be happy. You shouldn't be happy in this case, but in this case you should, because you only targeted for a minimum of 10%. So even the market PE is based on a weighted average PE, this takeover will still go through because Venitra is happy. Okay, now the last point here, since they asked us 7 marks, we're going to put the 7 points here. The other points, but let's make all the points into 7. I'm giving you comprehensive answers. I'm going to put all my points in this 7 points and make it look like a 7 point. Okay, now let me do some simple explanation here. Other points, yeah, others to consider, other points, other factors to consider. Now this point can be considered if it's only for a share for share exchange. If it's a share for share exchange, you can consider this. Now let me go out of this particular question. Yeah, let me go out of this particular question, assuming let's take the worst case situation. Worst case situation. Bergoni and Venitra. Now we're not told information like gearing. Assuming now Venitra's gearing is low. Assuming Venitra's gearing is low, Bergoni's gearing is high. It's not given. Our balance sheet information is not given. Assuming it's low and you're moving to Bergoni, which is a high gearing, well, I should say you should not be happy. Yeah, you should not be happy. It's a sad story. So you shouldn't be happy. What if it's risk? Well, if let's say worst case situation, yeah, if Venitra is having low business and financial risk, it's moving into a high basic risk conglomerate. By the way, a conglomerate shouldn't have a high risk here, but I'm just giving you in a worst case situation. So if your Venitra is low and it's high, if moving from a low to a high area, then you should not be happy. Yeah, you should not be happy. Now, of course, you can't draw all these things in exam. You have to put it in words. Is that okay? You have to make sure you put it in words. I'm just making it that you can remember in your exams. These drawings makes people remember better. Okay. Gearing risk. Maybe you can talk about dividend policy. Well, if Venitra is having generous dividend policy, and if Bergoni is having less generous dividend policy, then I think you're moving from a generous dividend policy to a less generous dividend policy. Venitra shareholders may not be happy. Is that clear? They may not be happy. Okay, what if it's going to be growth potential? Yeah, if it's going to be a growth potential. Now, if it's going to be from a high growth potential, example, I'm just giving you a worst case situation. We are not told about, actually we do know the growth rate of Venitra is 6% on average. Yeah, on average is 6%, assuming Bergoni is growing at 2%, so it's not happy either. Let's say if it's a high growth rate moving into a low growth rate. Yeah, if you're a high growth rate moving into a low growth rate, then I think Venitra will just say goodbye. We're not going to accept this offer. Is that clear? So this is what I have here. These are some points that you may want to consider. This is a share for share exchange. Remember, mind you, this is a share for share exchange. You can always stock these points here to decide whether Venitra shareholders will be happy. Okay, so that comes to our conclusion of this particular explanation of article today, Bergoni and Venitra business valuation article. Now, I wish you the best in your coming exams. If you want a soft copy of this, do email me at the banner of this video. You'll see my email address, and I'll be very happy to share them with you. Thank you and good luck.